Okay, we're live. Good afternoon, everybody. Jeremiah Conjure here from Annuity Association, and I'm bringing back another exclusive unbiased annuity review. Today, we're going to be covering the top 10, ranked number 10 on the indexed annuity overall sales list from Q3 of 2020. This product is made by Equitrust Life Insurance Company, and the product we're reviewing today is the Market Value Bonus Index, which is a fixed indexed annuity structured for pure accumulation and safe growth. And today we're going to be breaking this annuity down, covering the brochure, which I will give you the heads up. It's very simple and very short. So if you've watched any of our previous reviews, some of the brochures tend to be longer than others. So we'll be able to get through the brochure rather quickly. And then we're going to be really taking a look at the growth components of this indexed annuity to really see how it performs when back testing it over 10 and 15-year periods of time. So we're real excited to bring this to you. This is again, a top 10 selling indexed annuity on the overall independent annuity marketplace. So really want to break this down and bring a unbiased comparison so that we can take a look and really see what opportunities can be had inside of this annuity. So if you don't mind, I'm going to go ahead and start with our quick disclaimer. So let me go ahead and share my screen and we'll get that fun stuff out of the way. So let me go ahead and dive into this. Hopefully you can see this. And if you need to enlarge your screen, you can click at the bottom right-hand portion of your viewing screen to click that box, and it should enlarge it for us so that you can see everything a little bit better. All right, so Equitrust Life Insurance Company, the Market Power Bonus Indexed Fixed Indexed Annuity. This is a review, not a recommendation to buy or sell an annuity. Equitrust does not endorse this review in any way, nor do we receive any compensation for this review. This review is meant to be an independent review at the request of our website visitors so they can see our perspective when breaking down the positives and negatives of this particular annuity. Before purchasing any investment product, be sure to do your own due diligence and consult a properly licensed professional should you have any specific questions as they relate to your individual circumstances. All names, marks, and materials used for this review are property of their respective owners and not that of AnnuityAssociation.com. While care has been made to ensure this review is complete and accurate, no guarantees are made to the completeness or accuracy. All right, thanks for bearing with me through that. And now we're going to go ahead and dive into the brochure. Before we get started here, I always like to start our reviews, with really bringing forward the full transparency and the premise behind these unbiased annuity reviews. So, unlike any other consumer out there, I like to make sure that I am doing my own due diligence when considering purchasing a good or service. So, when you look at the annuity marketplace, it's really hard to gather enough information for in most situations to make an educated decision. So when Annuity Association was formed, our mission was to bring full transparency to the independent annuity marketplace, to allow you, the end consumer, to be able to compare products apples to apples so that you can make an educated decision on A, if an annuity is right for you, and then B, if you determine that the answer is yes, then which one's going to help you meet your financial objectives for retirement. So we've implemented a software that we use that has all of the independent annuity products available on the marketplace inside of it. And we're able to go in and compare apples to apples to really break down these products to see how they perform over long periods of time. And, and we break down and dissect the features and benefits to see what pros and cons there are associated with each individual product. So if you'd like to compare this annuity to another one that you own, or maybe you're thinking about buying, or maybe you're just looking for general information on indexed annuities and you want to compare the ones that are going to meet your financial objectives or help you meet your financial objectives, you can visit our website by going to www.annuityassociation.com. And if you'd like to work with me directly, when you go to the main page there, on the front web page, you'll see a green button that you'll enter your information, click submit, And it'll ask you if you'd like to be contacted by an advisor. Answer that question yes, and I will get in contact with you in a timely fashion to figure out a time that we can get together to take you through this process. So without further ado, we'll go ahead and get started. So I'm going to make this a little larger for you so we can see it all together very easily. So this is a fixed annuity offering that's index-linked performance with downside protection. And again, it's called the Market Power Bonus Index Annuity. And the reason why it says bonus, obviously, is because in this specific product, any premiums or investment dollars that go into this product during the first year will receive a 10% bonus applied to those dollars. So every $100,000 you put in, you'll be receiving a total of $10,000 in bonus. So when you're creating a strategy for your financial future, you generally face a trade-off between risk and reward. A fixed indexed annuity offers protection against downside risk and the opportunity to participate in the upside of market indexes or indices. The Market Power Bonus Index from Equitrust excuse me, life insurance company gives you the benefits when markets are rising and protection when they're fluctuating. Plus, there are tax advantages to owning a fixed annuity. And the bonus isn't just in the name. Equitrust will immediately credit your contract an extra 10% on any premiums paid during the first contract year. So that probably is one of the reasons why this annuity has been doing so well in the marketplace. Is it's one of the few that is set up for pure accumulation that offers this amount of bonus. There are other indexed annuities for pure accumulation that do offer bonuses, but this one tends to be one of the higher ones at that 10% mark. So that's very attractive to know that, hey, no matter what the index does, I just got 10% on my investment. Another way to look at it is if it's a 10-year product and you keep it for 10 years, well, you guaranteed yourself a 1% growth rate just by buying it. Anything else from the index goes on top of that. So that's another way to look at it. The Market Power Bonus Index enables you to lock in index gains and avoid market losses, guaranteed. When the market is up, you're up, and when it's down, you're not. Market Power Bonus Index Annuity never exposes your principal to market risk. You share only in index gains, not the losses, and you benefit from the tax-deferred earnings, withdrawal privileges, built-in guarantees, and the 10% premium bonus, all without investing directly in the stock market. You may choose among several accounts. The one-year interest account earns a traditional interest rate, and a variety of index accounts that earn credits based on changes in the S&P 500 or the custom risk-controlled Barclays Focus 50 index. Now, if you stick with us through the entire review, we're going to be breaking down really the specific indexes in this annuity to see how they would have performed over the last 10 and 15 year periods of time based on the parameters of the offering in the contract today. We'll be also diving in the Barclays Focus 50 index to really just look at the pure index itself to see how it's performed over those periods of time as well. So it'll give us a really good baseline to see what this thing does. On appropriate contract anniversaries, index credits are determined on index accounts and applied to your contract's current accumulation value. If the index continues steady growth, your accumulation value grows. And if the index declines, your accumulation value is simply unchanged from the preceding period's accumulation value. At the end of the surrender charge period, in this case it's 10 years, you have access to your contract's full accumulation value with no surrender charges. However, by leaving your money in Market Power Bonus Index beyond the surrender charge period, you do continue to earn interest in index credits on a tax-deferred basis. So all the surrender period or surrender charge period is for is these types of products are what we call time deposit required products. Because there's no market volatility risk and you're completely protected and shielded from that, the way that these programs are able to work is that they have to have a time requirement where the insurance company knows and understands that you're going to keep the money in the account for a set period of time. And in this case, it's 10 years. And that's how they're able to make the logistics work from the insurance company's perspective, so that they could still turn a profit. They can, still offer a very competitive rate to you as the investor, and they're also shielding your assets from 100% market, loss. So you're completely protected in this vehicle. But in addition, after the 10-year period, it doesn't mean that you have to cancel the product or roll the monies out or withdraw them all. All that means is there's no more surrender penalty, that if you do need to withdraw the monies, you can do that. But at that point, you're still month to month then. You're not in a contract. So you can leave it in the account and let it continue to grow if you've been happy with the performance. And at that point, you're just month to month. So just want to make sure that that's clear. Okay, so let's talk about the two index strategies found within the market power bonus index. And the first one is the S&P 500 index. It's widely regarded as the best single gauge of large cap U.S. equities. There is over $9.9 trillion indexed or benchmarked to the index, with index assets comprising approximately $3.4 trillion of this total. The index includes 500 of the leading companies in the United States and covers approximately 80% of available market capitalization. For more information, you can go to spindices.com or check out the ticker SPX. And then they have the Barclays Focus 50 Index. The Barclays Focus 50 Index seeks growth opportunities while limiting volatility through exposure to a dynamic combination of U.S. stocks and U.S. Treasury indices. Low volatility U.S. stocks are used because historically they have tended to outperform other higher volatility stocks on a risk-adjusted basis. The broad universe consists of all stocks listed on the New York Stock Exchange and NASDAQ, issued by companies headquartered in the United States. The addition of treasuries adds a diversification benefit and a potential reduction in risk. To further control risk, the index aims to limit its annual volatility to a 5% target using a process called volatility control. And for more information on this index, you can go to the Barclays website. So it's barclays.com/focus50, or check out the ticker, which is BXIIF50E. So I am a big advocate for these volatility controlled indexes, and it's really what's become one of the more popular types of indexes that are offered in these fixed indexed annuities. And the reason that I am an advocate for them is because the right way to use an indexed annuity is to de-risk an overall portfolio. And when you're looking at using an indexed annuity, the key is to be able to structure it in a way that's the index strategy is going to provide the investor or the contract holder the ability to earn consistent rates of interest over a long period of time. And the volatility controlled indexes are designed to do exactly that. Because of the way that they're dynamically structured to be able to rebalance real time according to the certain levels of volatility, in this case 5%. If one of the asset classes in this index ever triggers a 5% level of volatility, the index rebalances and moves the assets to uncorrelated asset classes to hedge the volatility. So why it's important is in very choppy markets and very up and down markets, which is what we've been in for quite a while now, it still allows the investor to earn interest on an annual, have a better opportunity to earn interest on an annual basis because of that ability to dynamically hedge. So there's a lot of these volatility controlled indexes that have launched within the last 10 years. And, it's really about finding the right one. So what we specialize in here at Annuity Association is breaking down these indexes and really understanding the methodologies behind them and then putting them through a rigorous back testing exercise to see how they would have performed through various market conditions and market periods of time. So at the end of the day, when you buy an indexed annuity, all of them are going to have that guaranteed 0% floor where you cannot lose money due to market volatility. but not all of them are created equal when it comes to the index strategy and the crediting method that's built into them. All of these indexes have their own nuances and different pros and cons. So it really comes down to finding the best one. And we feel that the best way to do that is to back test all of them to see what they actually perform at. So, I always look at it as the index and the index strategy within the annuity. That's the engine of the entire vehicle. So you can go buy any vehicle out there, but if the engine's not reliable, are you really going to get to where you want to go? Are you going to get to your destination? Are you going to meet your objectives and goals? So that's where it's key working with a professional to be able to help you identify the best indexes available on the market. And then once we find the indexes, then we find the annuity that offers them. The key thing too is that these indexes are proprietary to these insurance companies. These, people like Barclays and S&P and all of these other players out there, they license these proprietary indexes to the insurance company. And most oftentimes these indexes and the licensing is exclusive, meaning no other insurance company can have it. So it becomes a competitive edge when you have one of the stronger indexes licensed to you as an insurance company and it's exclusive to you. It becomes an edge over the rest of the competition. So that's another key, is finding the best one. So, okay, so I hope that all made sense. Let's continue on. So you control your money going in and coming out. So with premiums, after your initial premium payment, you may add subsequent premiums during the first contract year. The entire premium amount and 10% premium bonus are credited to the accumulation value. You may allocate your premiums among the crediting accounts described below. So all of these indexed annuities are going to offer a fixed rate account. It's a 1-year interest account, just like a fixed annuity would offer. And it's a fixed rate that's declared annually, and it's guaranteed for that annual year, that one contract year. On contract anniversaries, the rate may change subject to the contractual minimum guaranteed interest rate. All subsequent premiums received are applied to this account until the contract anniversary, then allocated per your instructions. So to be quite honest, it's very rare that people elect to put their monies in the fixed rate account. When you're buying an indexed annuity, you're buying it for the indexed opportunities and the growth that comes along with those. But there are products on the market right now, today, that offer a guaranteed 3% on the fixed account. So when you talk about that level of guarantee, even though it's an annual guarantee, it's still something to consider, because you can give yourself almost a guaranteed floor if you allocate dollars to that just 3% rate alone, which is pretty attractive. On the index accounts, there's a wide variety of index accounts that offer earnings called index credits based on the changes of a specified index. Credits for index-based accounts are never less than 0 and added to accounts at the end of the 1 or 2 year crediting period. Caps and participation rates are reset either annually or every 2 years, depending on the strategy that you're assigned or allocated to. On the S&P index accounts, they're going to offer, 5 different strategies. So the first one's a 1-year point-to-point with a cap. The next one is a 1-year monthly average cap. So on the point-to-point cap, let's explain that for those that are new to indexed annuities. I think it's important to understand these growth mechanisms. So a 1-year point-to-point is very simple. When you buy the annuity, you get assigned an anniversary date, which is the date the policy is issued. So once you've gone a year after that issue date, they're going to look at the starting point of the index, in this case, the S&P 500. So on the first day that the policy is issued, they're going to look at the starting point of the index, where the value is on the index at that day. Fast forward a year from that date, they're going to then look at the ending point of the S&P 500 index. If the ending point is higher than the starting point, well, then you had growth for that year. So that's the 1-year point-to-point. Now, when it has a cap, A cap is another word for a ceiling. It's the max that you can earn for that specific crediting strategy. So we'll be looking at the cap specific to this annuity. But for example purposes, let's say the cap is 5%. Well, if the index growth for that 1 year point to point was 10%, well, you have a cap of 5, so that's the most you can earn. They would credit your contract 5%. Okay, very simple. The monthly average cap works very similar, except from instead of looking at an annual point to point, they look at every single month. So month to month, and each month has a cap. So the cap may be 2%. So they'll look at the monthly gains for the index strategy. If it was 2% or more, you get 2%. If it's less than 2%, you'll get whatever the difference is there. That's lesser than the 2% cap. But then they average it out over that 12-month period for the 1 year. So you have, let's say you have 8 months of cap. You hit the cap for 8 months. So that's, 2 times 8, that's 16%. And then the last few months, let's say the last 4 months, you just had 0. Well, they're going to take that 16%, divide it by 12 months, and then that would be what the average is credited to your account at that time. So I hope that makes sense. Then they also have the same thing with the monthly average, but instead of a cap, it has a participation rate. So you just look at, so participation rate means of the index performance for that month in this case. So if for any given month, if it went up 10% for easy math, and you have a participation rate of 20%, well, then you participate in 20% of the growth, in this case, 10%. So your contract would be credited 2%. But they do that same formula for the entire year, looking at each individual month, determine the average, and then that's the credit you would receive. So they also offer 1 year monthly cap index account. They offer the 2 year monthly average cap index account. And then on the Barclays Focus 50, they offer a 1 year point to point participation. And then a 2 year point to point participation. So again, 1 year or 2 year crediting period. They look at the starting point and the ending point. If the ending point's higher than the starting point, you had positive growth. And then they multiply that positive growth, if it was 10%, let's say, by the participation rate, which determines how much you as the investor participate in that index growth. So if the participation rate's 50% and the index performance was 10%, you would get credited 5% to your account. Okay, let's talk about account transfers. On each contract anniversary, you may transfer money among the various accounts offered in your contract. Transfers out of a 2 year account are allowed only at the end of each 2 year period. What they're talking about there is upon each anniversary. So if you're in a 1 year point to point, at the end of that year, they're going to give you an option to reallocate the money from one index strategy to another one. If you're in a 2 year point to point, again, the same thing. At the end of that 2 year crediting period, they're going to give you a renewal letter that says, would you like to stay where you're at with the monies allocated to the current index strategy, or would you like to move them or transfer them to another index strategy? That's, again, key with working with a professional. We'll provide reviews to you on that anniversary date and really take a look at the index strategies offered to see if the one you have is the best one to stay with, or if there's better options that you should consider moving forward. Free withdrawals that are available in the Market Power Bonus Indexed Annuity. You may withdraw up to 10% of the accumulation value each year after the first contract year without paying any surrender charges whatsoever. Okay, lump sum payment options. Your contract's cash surrender value is available to you as a lump sum at any time. Surrender charges are in effect during the first 14 contract years and are a percentage of the accumulation value and decline annually. So there is a large surrender penalty for these. In this specific product, we'll be taking a look at that in detail just momentarily. And then on the premium bonus, the 10% premium bonus is added to your premium payments immediately and is a permanent part of your accumulation value. You then earn interest and index credits on your premium and 10% bonus. And if you surrender your contract, a surrender charge and market value adjustment may be applied to the full accumulation value, but you don't lose your bonus. In the event of your death, 100% of your premium bonus is included in the death benefit. So when we take a look at the surrender penalties, you're going to notice they're very high compared to the average indexed annuity. And the reason being is that the way they have this account structured with the bonus is vested day one or year one. So on the surrender schedule, if you decide to exit early and not hold up your end of the agreement, if you sign into a 10-year product, signed up for a 10-year product and you exit early, you're going to have a surrender charge. Well, they're basically recouping that 10% bonus. So they've applied those to the surrender charges that are in this product. So we'll see that here momentarily. We talked about 100% of your premium bonus is included in the death benefit. So if you die within the first 10 years, one of the biggest misconceptions of annuities is that the insurance company keeps your money if you die. Entirely false. 99% of annuities out there do not keep your money. Insurance companies do not keep your money if you die. The only product that does that is called an immediate income annuity, or what's referred to as a single premium immediate annuity that's structured for life only. There's many ways to structure an immediate income annuity, but if you choose life only, that means if you pass away, the money's gone. And indexed annuities, there's a death benefit, and the death benefit will always equal the account value as well. So that if you have $100,000 in your account, the death benefit will always be $100,000 too, even if you're still within that 10-year surrender period. Your beneficiaries or your loved ones or your heirs will never pay a surrender penalty or market value adjustment because you passed away. They're going to receive 100% of the monies that's in the account. Again, we talked about the value of tax deferral. Currently, all interest income earned on an annuity accumulates on a tax-deferred basis. So this is where it differs from a bank CD. You don't have to claim the interest that was earned on an annual basis. Everything grows in an annuity tax-deferred. No income taxes are payable until you receive a payment from your contract. So no taxes are due until you decide to take a withdrawal. If you're under age 59 and a half at the time of a withdrawal, an additional 10% IRS penalty may be imposed if the monies that were used to fund it are qualified dollars. So if they came from a 401k or an IRA or any other qualified account, the same federal tax laws apply. Minimum guaranteed contract value is no less than 87.5% of your premiums, less any premium withdrawal or partial withdrawals accumulated at the minimum guaranteed contract rate. So the minimum guaranteed contract value is accounting for if you're within that 10-year surrender period and you have surrender charges and market value adjustments that are applied if you exited early, they have a guarantee that it can never be less than 87.5%, no matter what the market or economy is like at that time. Nursing home waiver. For additional peace of mind, your contract includes a nursing home waiver. If you are confined to a nursing home or hospital for 90 days or more, your contract accumulation value will be available without surrender charges or market value adjustments beginning in the second contract year and during your confinement. There is no charge for this waiver. So that's very good peace of mind. Another misconception about annuities is that, if something happens regarding your health and you need access to the money and you're within that surrender period, that your money's locked up. That's entirely false as well. Most of these annuities, if not all of them today, offer some sort of nursing home or what's called a confined care provision that's included at no charge, that in the event you qualify, which is needing a nursing home or confined care, you can receive 100% of your accumulation value as a lump sum with no penalties. They also offer terminal illness rider. If you are diagnosed with a terminal illness, charges will be waived for a withdrawal up to 75% of the accumulation. Again, there's no charge for this feature as well. Benefits upon death of the owner. If you die, the full accumulation value is paid to the beneficiary without surrender charges. And then with any annuity, you can have what's called a free look period. After your contract is issued, you have a specified number of days to review it. See your contract for complete details. If you're not completely satisfied with the terms, you may return the contract and receive 100% of your premiums paid minus any prior withdrawals. Okay, now they do offer an optional income rider on this annuity. This optional benefit offers a lifetime income based on 6% accumulation for up to 10 years. A guaranteed income stream for life without annuitizing the account value. So that's key. One of the traditional or oldest ways of creating a lifetime income is what's known as annuitization. Annuitizing your contract means you're giving up control of the account value in exchange for a lifetime income payment guaranteed by the insurance company. Today, these fixed indexed annuities offer lifetime income riders, okay? And what that does is it doesn't mean that you have to now annuitize your account value to be able to receive a guaranteed income stream for life. And when you add the rider, okay, which most of the time there's a fee charged to the account value for, it still keeps the account value in your control. So over time, if you need additional liquidity, you have access to that account value to be able to pull out the money and do whatever it is that you need to do with it. But you always have that guaranteed income stream coming in for life. Now, the income stream can be adjusted based on if you do take withdrawals out of that account value, but basically the key here is understanding that that account value can be maintained over a long period of time, and that in the event you pass away, that income stream would stop, but whatever's left in the account value would go to your beneficiaries designated in the contract. So very, very important to note there. In addition, the income rider does offer the ability to double your income for up to 5 years in the event of a chronic illness. So when you buy this income rider, it's going to give you a stated amount of income for the rest of your life, depending on the year you turn it on. And once that guaranteed income is started, in the event down the road that you have a need for health care due to a chronic illness, the rider will double whatever that minimum guaranteed income is. It'll double that amount and pay you that amount for up to 5 years. Very nice peace of mind there. You also have flexibility and control to start and stop income payments when you choose. So another misunderstanding is that when you activate income, you're stuck. It's going to come every month and every year forever, even if you don't need it. That's not true. You can start and stop the income payments as you wish. Anytime after the first contract year and age 50, you can elect to begin lifetime income withdrawals, and your payments will never decrease if you withdraw only your income amount each year. All right, so let's go back up here. So they're talking about the income withdrawal amount on this calculation. It's showing the income withdrawal percentage multiplied by the benefit base, and that equals your income withdrawal amount. At each contract anniversary, your income withdrawal amount will be recalculated as the greater of the prior year's income withdrawal amount or the original income withdrawal percentage multiplied by the current benefit base. So the withdrawal percentage is going to be based on your age at the time you first elect to receive income withdrawals. And once you start receiving those withdrawals, the withdrawal percentage will be locked in and never change. So they give the chart here with the withdrawal charge percentage or withdrawal percentages. And basically what they do is in this particular product, it's every 5 years, the withdrawal percentage, increases. So every 5 years, the withdrawal percentage increases. So each year that every 5 years that you continue to defer the income, then you could potentially have a higher withdrawal percentage when you eventually go to turn it on. Once you do turn it on, that withdrawal percentage at that time is locked in forever. And the benefit base, which is used to determine the income amount, is equal to all premiums and premium bonuses less withdrawals compounded at 6% for up to 10 years on the start of the income withdrawal. So this is a great benefit if you're looking for income later and you're maybe approaching retirement in the next 10 years. You can purchase this annuity, add the income rider, and know that no matter what happens with the markets moving forward during the next 10 years, you're going to get bare minimum a 6% compounded roll-up rate applied to your benefit base. Now, the benefit base is just used to determine the income amount, and it's not withdrawable as a lump sum, but it's key knowing that regardless of what the markets did, that you've had an income benefit base growing at 6% compounded over that 10-year period of time. Huge benefit there. Okay, and it says after income withdrawals have started, the benefit base will be set equal to the accumulation value on each subsequent contract anniversary year if the accumulation value is higher. This allows for income withdrawal amounts to potentially increase. Okay, so what that's saying, let's break that down. So the benefit base is going to grow at a guaranteed 6% if you have the rider, compounded over 10 years. But at the end of each subsequent contract anniversary, they're going to also take a look at the accumulation value, which has been growing according to the underlying index strategies that you're allocated to. And if the accumulation value is higher than the benefit base, so breaking that down, if the accumulation value performs above that guaranteed 6% compounded roll-up rate, then they're going to credit your income benefit base the higher amount. So if the accumulation value is at 100,000 and the benefit base was only at 80,000, they're going to upgrade your benefit base to the 100,000 because the accumulation value is higher. So that gives you the potential to have increasing income year to year, which is very, very nice to know. Okay, so I'm not going to go through this. These are the income withdrawal rules. We'll be here all day if we went over this entire chart. But basically what they're doing is breaking down this $100,000 premium example and then showing you what the income amount would be based on these 4 age brackets, 60, 65, 70, and 75. And then if you turned income on in 1 year, 5 years, 10 years, or after 14 years. And then the rider charge is the annual rider fee of 1.25% of your accumulation value on each contract anniversary, and the fee is deducted proportionately from each crediting account. So if you're allocated to multiple index options, it's going to minus 1.25% annually on each contract anniversary from each index strategy that you're allocated to. The election of the income rider may result in lower cap rates, par rates, or interest rate. Combined with the annual rider fee, these lower rates may result in a lower accumulation value. This applies for the life of your contract, even if the income rider is subsequently terminated. So basically, if you're looking at just pure accumulation, then don't add the income rider because you're going to have that 1.25% fee. But if you're looking for the income and you like the idea of that guarantee, what they're saying is if you elect the income rider, it could potentially impact the rates on the participation cap or spread rates or other interest rates in the contract. So you'll want to analyze those and make sure that you're making the right decision. Okay, for that enhanced income withdrawals, if you become chronically ill, the income withdrawal amounts may be doubled for up to 5 years. And for joint owners, the increase is 50%. So if there's 2 lives being covered by the income annuity rider, then instead of it being doubled, it would be increased by 50%. A chronic illness is defined as the permanent inability to perform at least 2 of 6 activities of daily living, which include eating, toileting, transferring, bathing, dressing, and continence, or permanent severe cognitive impairment. If utilized, the original income payout amount resumes when enhanced income withdrawals end. So that's really nice. If you have this confined event or this chronic illness event, the income amount is going to double or increase by 50% of structured joint. And then after that 5 years, your income will decrease back to the original guaranteed amount. So it will not end permanently. It's still just going to revert back to the original amount for the rest of your life. Okay, so now we're going to go ahead and jump on over to our software where we're going to be taking a look at our back-tested performance on the market power bonus index offered by Equitrust. So bear with me. I'm going to go ahead and share my screen and then we'll dive in. Okay. All right, so what we're looking at here is the hypothetical back-tested performance of the market power bonus index. What we're looking at to the right-hand side here are the 3 columns, the 10, 15, and 20-year periods. And what we're doing here is identifying the highest performing index strategies listed in chronological order from highest to lowest based on that 10-year column in terms of who's performed the best over the last 10-year period, hypothetically speaking. To determine, what strategy is going to give us that highest economic growth opportunity moving forward. Now, I must make the disclaimer that prior performance is not always an indicator of future performance. None of us have a crystal ball, and none of us know what the markets are going to do tomorrow, let alone, during the next 10 years. So we just want to make sure that we're understanding that this is just an exercise to give us an idea of how they've performed or would have performed over the last 10 and 15-year periods of time to help us make an educated decision on what they could potentially do moving forward. So as we'll see here, the highest economic growth opportunity when looking back over this period of time is the 2-year Barclays Focus 50 point-to-point with the participation rate. Now, when we're looking at the 10-year column, the large number is going to be the average annualized credited interest rate when looking back over the last 10 years from December 31st of 2010 to December 31st of 2020. So here, that particular strategy performed at 3.39% on average. And then what we also do is take it a step further and look back over the last 20-year periods to determine what the worst 10-year period would have been and what the best 10-year period would have been. In this particular case, the best 10-year period, which is the green number below that, is from February 14th of 2010 to February 14th of 2020. The best 10-year period would have performed on average at 4.05% average annualized credited interest. And in addition, the worst 10-year period from March 8th of 2004 to March 8th of 2014, we see 2.78%. And then lastly, over the last 15 years from December 31st of 2005 to December 31st of 2020, we see this would have performed at 2.9% on average. Now, this is utilizing, again, the 2-year Barclays Focus 50 point-to-point with participation rate. We'll see that the participation rate that's currently offered at the time of this review is 50%. So again, the participation rate just determines of that index strategy performance, how much do you as the investor get to participate in. So if that index went up 10%, your participation's 50%, you would get half or 50% of that 10%, which would equate to a 5% credit to your account value. In addition, we also weigh out all of the other strategies that are found within the Market Power Bonus Index as well. We'll see the 1-year Barclays Focus 50 point-to-point comes in with the participation rate at 30%, and we'll see 2.15% over the last 10 years on average, the highest 10 years at 2.4, and the lowest 10 years at 1.75, and then over the last 15 years at 1.87. Now, this is the product that includes the 10% bonus on your initial premium. So every $100,000 you put in, you're going to get $10,000 in bonus applied day one. So really it comes down to weighing out, that bonus is a guarantee as long as you hold up your end of the bargain, and that is continuing your contract for the 14-year period. And it really comes down to then breaking it down and saying, well, over the last 10 years, this performed at 3.39. You factor in the bonus, it's under 1% a year when you're factoring against 14 years. So are there other indexed annuities structured for accumulation that could give you a higher economic benefit even without a bonus? And that's really the good question to ask. And it really comes down to working with a professional that can help you determine that, by comparing apples to apples and, taking a look at the independent marketplace again to see which products are available that are going to ultimately help you meet your objectives. And here at Annuity Association, we follow the best interest suitability rule, which means that, we're going to first understand your objectives and goals first, and then make the right recommendations that are going to help you meet your objectives and goals, and that ultimately are in your best interest. So in addition, we do look at the other point-to-point strategies or index crediting strategies. Here we have the 1-year S&P 500 point-to-point with the monthly sum cap. But as you can see, the return when doing this backtest exercise isn't very attractive. So if you are looking for growth opportunities within fixed indexed annuities and you're looking for the highest opportunity moving forward, well, we can take you through this process and take you through, really a back test that's going to show you all of the independent products stacked in chronological order so that we can make an apples to apples comparison. If you'd like to do that, you can visit our website by going to annuityassociation.com. Right on the main page, click the green button to request your free report. And if you'd like for me to contact you directly and you'd like to work together, you can answer the question yes if you'd like to be contacted, and I'll reach out to you in a timely fashion. Now, we do service all 50 states here in the U.S., so even though we're located in Florida, we can hop on a Zoom meeting and be able to share our screen so that you can view real time all of the products that we're taking a look at and ask any pertinent questions that you may have from that point. If you decide that you like what you see and you'd like to move forward, all of the applications and paperwork are done through a digital process with electronic signatures. So it's very easy and convenient in all things that you can do from the comfort of your own home. So we would appreciate that opportunity. So, all right. So now we're going to go ahead and take a look at an example illustration with this particular product. So bear with me. I'm going to go ahead and share my screen again, and I'll dive right in. Okay, so we have the Equitrust Life Market Power Bonus Index. We're going to use a male age 60 in the state of Florida. Now, we do cover all 50 states, so if you're not in our home state of Florida, but you'd like to work with me directly, we can still do that. We're licensed in all 50 states, so depending on where you are geographically, we can still connect using a Zoom meeting platform and take you through this process where I'll share my screen. We can look at everything and do our comparison analysis. And then if you like what you see and you'd like to move forward, all of our all of our applications are electronic with electronic digital signatures that are safe and secure so that you can complete everything in an efficient and convenient manner, all from the comfort of your own home. So bear with me. I'm going to go ahead and hit next here. And then what's neat about our software, we're going to use $100,000 for the premium, is that we're able to take a look at all of the specific index crediting strategies available in each product and then figure out what the average rate of return is over the last 10-year period when diversifying the particular strategies. So for example, instead of putting all of the investment into one particular crediting strategy, you can diversify it and break it down across multiples within the same product. So if, for example, in this one here at the bottom right, you can put 70% in the 2-year Barclays Focus 50 and then 30% of the dollars into the 1-year Barclays Focus 50. And then we're able to analyze that strategy and see what the average rate of return was using the last 10 years of time and the data associated with it. So for this illustration purpose, we're just going to select the 2-year Barclays Focus 50 index with the participation rate and take a look and see how that performs. So we have our 10% bonus going in on the $100,000. And again, 2-year Barclays Focus 50 with the 50% participation rate on that strategy. Here we're going to see the 10-year most recent calendar period, and we're going to see how it looks on this ledger or illustration. You have your green column, which is the accumulation value. You'll see fees is 0 for every single year, since this is a 0-fee product unless an income rider was added. And then you'll see the death benefit column all the way to the far right, which is going to match the accumulation value throughout the life of the contract. Since it is a 2-year point-to-point crediting strategy, you're going to see each subsequent year have a credit of 0, but then at the end of that 2-year crediting period is when the interest will hit the account. In this case, at the end of contract year 2, we see 9.11% going in on the multiplied by the 110,000, which is the $100,000 initial premium plus the 10% bonus. And we'll see that once that interest is credited, the account accumulation value goes up to $120,021. You'll see that strategy every 2 years, it credits the interest. And by the end of the 10-year period, we've grown the accumulation value from $100,000 to $153,471, including that 10% bonus. At the end of 14 years, we'll see that grow to $186,375 after factoring in all of the credited interest and the bonus. Here's the interest credited column. So you'll see every 2 years, that's also being factored and credited to the account balance. And you'll notice the surrender column is factoring in the surrender charges. But once we get to year 14, since this is a 14-year surrender product, you'll see that the surrender value column matches the accumulation value column and the death benefit column as well. One last thing we'll take a look at on this illustration is, again, it does break down the most recent 10-year performance, which is an annual credit of 3.39%. The highest 10-year performance is 4.05, and the lowest 10-year performance at 2.78. I think it's really key to make the decision on whether or not you should move forward with any indexed annuity based on the worst case scenario, not the best case scenario. We know that we've been on this long bull market run, and every financial product for that matter has performed rather well. But really what we want to look at is a stressed period of time. And in this case, on this example, we're looking at March 9th of 2005 through March 9th of 2014. So it's taking us through the Great Recession, or what's also known as the global financial crisis that occurred in years 2007 and 2008. And I think that's really the key point, is to make sure that we're comfortable with the worst possible scenario when looking at a stressed 10-year period. And is that rate of return still comfortable with us? And if so, then maybe move forward, because we know that we also have upside potential above and beyond that if markets perform better. So I think that's key. Make your decision on the worst case scenario, not the best case. All right, now we're going to take a look at the indexes themselves and take a look at the specific performance and see how those stack up. And if you'd like to get a sample illustration like this that's more applicable to your unique situation, you can visit our website at annuityassociation.com. Right there on the main page, click the green button to request your free report. Okay, bear with me. I'm going to go ahead and dive into that portion here. Take a quick look at the specific indexes that are offered in the Market Power Bonus Index. Market Bonus Power Index. I think I keep getting that backwards. So we're going to look at the Focus 50, the S&P Mark 5, and then the true S&P. Okay. Do not judge these indexes based on their current year-to-date performance. We're only a few months into the year, and you'll see that they may be, these ones are in the red at the present time, but don't judge them on that. Judge them over the longer periods of time. So what we really want to look at, for example, last year was a very volatile year, but markets rebounded towards the last, third and fourth quarter. So the S&P at 15.5. The Barclays Focus 50 at 2.65, and the S&P 500 Mark 5 at 8.28. 2019, 28.8, 12.36, and 13.7. And then now let's look at the 5 years. The last 5 years, the S&P at 14.16, the Barclays Focus 50 at 4.23, and the S&P 500 Mark at 4.53. And then 10 years, 12% on the S&P 500 index, 6.22 on the Barclays Focus 50, and 4.4 on the S&P 500 Mark 5. These numbers are year to date, so it's up to this point, looking back over the last 10 years. And then here's an interesting stat: is that since inception, 7.28%, 2.17 on the Barclays Focus 50, and 5.05% on the S&P Mark 5. Okay, so I appreciate you tuning in. Hope that I was able to add some value to you this afternoon. We're all about bringing that transparency to you, the end consumer, on whether or not a fixed indexed annuity is right for you. And if so, our job and mission is to help you identify the best one that's going to meet your needs and objectives. If you'd like to work with me directly and you need help comparing some annuities on the market, whether it be for income or safe growth, you can visit our website at annuityassociation.com. Right there on the main page, click the green button to request your free report. And there'll be a question on that opt-in form that'll ask you if you'd like to be contacted. Just answer yes, and I will reach out to you in a timely fashion to schedule a time that is convenient, that we can take you through this process and really start to identify the right annuities for your objectives. So thanks so much for tuning in. If you got some value out of this video, please click the thumbs up button, share this video with some friends and family. It'll help this video rank to just get the word out there more to help other people looking for this helpful information. So thanks for the opportunity to work with you. Hope you have a wonderful weekend. This is Jeremiah Conger signing off at annuityassociation.com. Take care of one another. Thank you so much.